gold goes to 25,000 or 2,500 or 3,000, you can be pretty sure that Barrick and Newmont and Agnico and Wheaton and Franco, you can be pretty sure that all of those will give you good returns. I think that means that the dollar is going to decline. And where do these people put their money? I mean, you know, 5 years, 10 years ago, they might have put some of it into the euro, but I don't think a lot of central banks are wanting to have too much in the euro right now. You know, gold is clearly the answer. Physical assets and gold are the answer. By physical assets, I don't mean commodities. It could be commodities, it could be factories, but, you know, real assets.
Gold weakens typically in times of U.S. dollar strength, but this correlation has broken over the past weeks as a strong safety bid, driven by increasing tensions in the Middle East, has pushed gold into record-high territory. Gold is testing $2,400, and a confirmed break higher would see $2,500 as the next level of resistance. Adrian Day, president of Adrian Day Asset Management, believes that as the dollar weakens, people will likely turn to alternative investments like gold and tangible assets like factories. In his analysis, Adrian expresses that with the risk of violence in the U.S., a slowing economy, and a large fiscal deficit, it makes sense to be defensive. He believes this involves moving money offshore, reducing stock market exposure, and investing in gold. The price of gold in the S&P 500 reached new record highs after the Federal Reserve signaled that it's still expecting to cut interest rates this year. Both assets have had a strong first quarter so far in 2024, and as they reach new all-time highs, you may be wondering which is the better investment, as well as looking at online gold dealers or gold IRAs. Historically, looking back 20 years, gold has outperformed the S&P 500. Based on his recent observations, Adrian says central banks has been buying gold over the past 18 months to diversify assets due to dollar weaponization. He notes that Chinese savers, worried about their banking system and economy, have also bought gold heavily. While challenging U.S. economic dominance over the past 30 years, China has accumulated vast foreign exchange reserves, mostly in dollars. However, Beijing now fears over-reliance on the dollar and seeks to diversify the PBC's reserves. In response, China's central bank has steadily increased its gold reserves while reducing its holdings of U.S. debt. Additionally, Chinese speculators are fueling this trend, betting on further appreciation of gold. Despite the negative macroeconomic environment leading to decreased gold buying by Western investors, Adrian believes that investors are not currently overweight in gold. Now, we present the clips of Adrian Day's insights from his recent interview with David Lin. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I wouldn't be at all surprised if we saw, well, I wouldn't be at all surprised at this point if we see 2,500 and 2,550. And a lot of people listening are going to say, is that it? Is that all there is? But let me just say one other thing. Sorry, but people that are buying the gold stocks right now are big, the US gold stocks, because it's not Chinese buyers, as you said. The people that are buying the North American gold stocks right now are, by and large, very large, sophisticated buyers. They're people like Druckenmiller. They're people like Michael Burry. They're people, you know, sophisticated, big buyers. Retail buyers are not yet buying. Now, those people can be wrong, of course, and the retail can be right, but that's not normally the way it goes. So if you have a meaningful risk of violence in the US, given the fact that the economy is slowing and given the fact that we have an awful fiscal deficit, I think it only makes sense to start being defensive and to protect yourself. And part of that means moving some money offshore. Part of that means moving out of the stock market. Part of that means moving into gold. I would agree with that general scenario. I mean, I'm not sure I'd go to India as a way of protecting my assets, but the general theme I certainly agree with. Buying for gold over the last year and even this year, but over the last 18 months, including this year, the buying has come from central banks wanting to diversify their assets in the face of the weaponization of the dollar. They're not looking at what the dollar is or what interest rates are or what the US stock market is. Doing it as a long-term defensive move. You look at Asian, the second largest segment of gold has been Chinese savers. Chinese people are worried about the banking system. They're worried about the slowing of the economy and the potential for stimulus, all of which will hurt and the potential for devaluation of the yuan. So they're looking for a place to put their assets. They don't want to put them in the banks because the banks are unstable. They don't want to put them in real estate in China for pretty obvious reasons. We don't want to talk about that. And until recently, they haven't wanted to put them in the stock market. They're not allowed to put them in crypto. So the only place left to protect your assets is gold. So Chinese buying of gold has been remarkably strong in the last 6 weeks. I'm talking about private buying in addition to the government. And now those people too, they're not looking at, well, what's US interest rates doing? What's the S&P doing? They're buying for other reasons. And so I think yes, you're absolutely right. And the fact is, the fact is that you mentioned the macroeconomic environment, which is very negative for gold. If you just look at it, not looking ahead, just looking at where we are right now, is negative for gold. So the macroeconomic environment, which is negative for gold, has meant that Western investors, retail investors, institutional investors, generally speaking, there's always buyers and sellers, but generally speaking, they are not buying gold. They have not been buying gold. You're absolutely right. And the GLD, which is the physical gold ETF, has seen net outflows. As I say, I looked at the last weeks, 3 out of 6 days were outflows. But if you look at this year, we've had maybe 4 out of 5 days have been outflows. You look at coins, which is a good reflection of retail. All the coin dealers I talk to say they're getting more people calling them to sell their gold than they're calling them to buy gold. That's true in Europe as well as in North America. And a reflection of that is the premiums on coins and the deliveries, the shipments from the mints. They're way down. So that's a reflection of a lack of interest. So you're absolutely right. But from a contrarian point of view, I think that's, I feel very, very positive about that because it means people are just not overweight gold at the moment.
Regarding Adrian Day's beliefs, if their gold predictions materialize in the next few months and interest rates decrease while gold holds steady, gold stocks will offer a remarkable buying opportunity. He cites undervalued companies like Agnico Eagle and Barrick, with appealing price-to-free cash flow and price-to-book value ratios. An index that tracks metals mining shares has climbed its highest in almost 2 years, with room to run even higher as companies that mine precious metals continue catching up to gold's rise to record-high prices and silver's climb to 11-year highs. According to Dow Jones market data, the NYSE Arca Gold Miners Index, which mainly tracks the performance of companies in the gold mining industry, was up 17.2% this year, as of Friday, with over half or 9.6% of that gain scored so far in May, according to Dow Jones market data. Moreover, Adrian compares the current situation to historical gold movements, emphasizing that, unlike previous instances where investors had to chase gold stocks, they are undervalued and should be taken advantage of. Let's get back to the interview.
Gold, let's say 12 months from now and 18 months from now, if we are right about that 12 months from now, so we're going to see interest rate cuts and gold is going to stay more or less where it is, then I would say that the gold stocks are the most incredible buy imaginable. And for 2 reasons. One is, you're looking at companies, and just as an example, Agnico, which has obviously had a huge run in the last 6 weeks. It's been one of the top performers, but it is still selling. It's at the high price now since the middle of, for 3 years. It's at this high price for 3 years. But on a price to free cash flow, it is still selling at essentially the lowest multiple that it has in 40 years. If you look at Barrick, same thing, essentially the lowest price to book value and the lowest price to cash flow in 20 and 30 years. So the stocks are remarkably undervalued. And you look at the first quarter earnings, but from most companies were pretty good. Let's not forget the big move in gold didn't happen until March. So right now, gold mining companies are selling their gold for $200 more than the average price they sold in the first quarter. So we're going to get a very, very strong second quarter in terms of cash flow. The gold stocks are cheap. They're doing well right now this year. They're doing very well. The cash flows are very, very strong. And we have a remarkable, because of the peculiar circumstances that we've talked about with gold buying and with so on, we have a remarkable opportunity where gold has taken off, but the gold stocks are still remarkably, well, are lagging and are still remarkably undervalued. If you look at gold this year, the gold stocks have only just in the last week outperformed gold. If we'd have had this interview a week ago, I would be saying that gold is still outperforming the gold stocks of this year. But if you look back to 1976, look back to 2001, look back to 2009, at the beginning of big gold moves, you didn't have the opportunity to buy the gold stocks. Let me just say, go back to 2001. In first 6 months, the XAU was up 27%. Gold was up less than 5%. So anyone who wanted to buy gold stocks had to chase them. You look at 2008, even more dramatic. The XAU was up 50% in 1 week from the bottom, and it was up 70% in 1 month from the bottom. And gold was up about 20%, in 3 months. So again, if you wanted to buy gold stocks, you had to chase them. Right now, we're in a situation where gold, as you know, is up whatever, 20% this year. And we don't have to chase the stocks. They're still lagging. They're still remarkably undervalued. It's an anomaly, but an anomaly we should take advantage of, I think.
Despite strong fundamentals, major gold stocks remain significantly undervalued compared to gold itself. Initially overlooked due to the stock market bubble, traders are now beginning to notice gold's breakout, driving gold stock outperformance. What are your thoughts on the potential for gold and gold stocks in the coming months? Do you believe now is the right time to invest in this sector? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.